Welcome to The Explainer. Today, we're trying to make sense of a really volatile day in the US economy. We saw some conflicting signals that gave just about everyone a case of financial whiplash. So, on Friday, March 6, 2026, headlines like this just started popping up everywhere. They really seemed to come out of nowhere, and it left a lot of people scratching their heads, asking one simple question. All right, so to really get what's behind this market drop, we've got to look at two pretty big economic shocks that hit at pretty much the exact same time. So let's dive into the first one. The biggest surprise, it definitely came from the US jobs report for February. It just completely missed expectations, and you could feel a chill run through the market. So check this out. Economists were forecasting a gain, a modest gain of about 60,000 jobs. But the actual report? A loss of 92,000 jobs. I mean, that is a massive 152,000 job swing from what the experts predicted. The losses were really concentrated in places like construction and hospitality, and then immediately raised some serious concerns about the health of the labor market. And all of this pushed the unemployment rate up to 4.4%. Now, I know, going from 4.3 to 4.4, it might not sound like a huge deal, but here's the thing. After a really long period of stability, any move in the wrong direction gets a ton of attention.
Okay, so as those job numbers are sending shockwaves through the system, a second punch was landing. This time, it was coming from the global energy markets. A real double hit to economic stability.
So what happened? Well, because of some geopolitical events over in the Persian Gulf, shipping actually halted through the Strait of Hormuz. Oil prices just spiked. We're talking a 2-year high, over $86 a barrel. Look at that jump, over 6% in a single day. That is huge, and it has these immediate knock-on effects on everything from the price you pay at the pump to how much it costs companies to ship their goods. So now you've got this combination, right? A weak job market and surging oil prices. What does that mean for the folks at the Federal Reserve? Well, to put it simply, it means they are caught between a rock and a hard place. It's a massive headache for them. This whole situation raises the dreaded risk of something called stagflation. And let me tell you, stagflation is a central banker's worst nightmare. It's this nasty economic problem that's so hard to solve because the tools you'd normally use to fight one part of it, well, they can actually make the other part worse. And this really lays out the Fed's dilemma perfectly. On the one hand, you've got these job losses, right? That's a signal the economy is weakening, and it might need a boost, like lower interest rates. But on the other hand, those surging oil prices are creating inflation, and the typical playbook for that is to raise rates to cool things down. See the problem? You can't really do both. There is just no easy answer here.
Okay, but here's where the story gets really interesting. Because just one day before all this bad news hit the fan, a completely different narrative was unfolding. This one came from the shopping cart, and it suggested the American consumer was actually doing pretty great.
The retail giant Costco announced its earnings, and they were fantastic. I mean, they blew past expectations. Look at this growth across the board. Net sales up over 9%, net income up almost 14%, and those super important membership fees up over 13%. This is absolutely not the kind of data you'd expect to see if consumers were really struggling.
And you know what? This wasn't just a US story either. Their sales were growing solidly in all their major markets. I mean, look at Canada, up over 10%, and their other international stores up a whopping 13%. That's some serious double-digit growth.
But maybe the most surprising number of all was this one. Costco's digitally enabled sales, basically their online business, grew by more than 22%. That is a huge signal that the modern consumer is healthy, they're engaged, and they are definitely still spending, even if they're doing it from their couch. So where does that leave us? We're left with these two totally conflicting signals, right? On one side, you have this really worrying big picture economy with job losses and an oil shock. And on the other, you have this incredibly resilient American shopper. It's like we're trying to read two different sets of tea leaves. What does it all mean for what comes next? Okay, so here are the key things that economists and investors are going to be watching like a hawk. First up, the Fed's next rate decision on March 18th. That's a big one. Of course, everyone's eyes will be on global oil prices and what's happening in the Strait of Hormuz. And then there's the next jobs report. Was this a one-time blip, or is it the start of a scary trend? Ultimately, we need to know which story, the weak economy or the strong consumer, is the one that's going to win out. And that leaves us with the million-dollar question, doesn't it? Is all this just a temporary blip, a short-term, knee-jerk reaction to a couple of bad reports? Or is this the first real sign that the fundamental pillars of our economy are actually starting to shift?